Jim, this is not about the inverted yield curve. This is about slower global growth. That's why the market is down. And you can see the sectors, of course, that are always moving on global growth are weaker. The banks, semiconductors, energy, industrials. This is a new low for the year. In energy stocks, a lot of 10-year lows in that particular sector. As I said, I know everybody's concerned about the inverted yield curve. The inverted yield curve is an effect. It is not a cause. The cause of this is slower global growth. And we see the numbers today. Look at these big international numbers that we've been seeing. China industrial output up 4.8%. It was supposed to be up 6%. This is the lowest we have seen in 17 years for China. German GDP is negative, down 0.1%. It was up 0.4% in the prior quarter. Weaker global growth is the problems that we're seeing right now overall. You could see this in Europe, in the autos. They're all down notably today. They're all sitting at new lows. There's Daimler and Volkswagen and BMW. It's not shocking because they see the Chinese numbers as well as we do here. That's a multi-year low, by the way, for Daimler. You see the semiconductors, another just proxy for global growth. Those stocks are all on the weak side today. You don't even have to pick them out. They're all down as a group. Oil, we've been talking about Occidental. We're at 10-year lows. It's a $40 billion market cap now in some of these oil stocks here. Halliburton, that's a 10-year low here. These are weak here, though not 10-year lows. But these are all, again, global growth stories. Ultimately, we've talked all morning about Macy's and the effect there about what's going on in the department stores. So you get the retail effect as well. And you put it all together, we've seen a shift into defensive stocks. Now, we asked our friends at Kensho, okay, so what about this freak out on the inverted yield curve? We've had this 3 times since 1980s. We've seen that. Put up the Kensho chart here for you. And what we've seen is 6 months after the yield curve inverted, the last 3 times that happened, what we saw is utilities are up. No surprise there. Consumer staples tend to be up 6 months later. But the S&P is also up 3.5%. So everybody said, oh, we're in imminent danger here of the market turning south. History, at least the last several times this has happened, doesn't necessarily support that. So what do you buy? You know what does tend to do well is the dividend-yielding stocks. Obviously, you saw the utilities. There's ETFs. There's a whole bunch of ETFs that do this. The Vanguard Dividend Appreciation, VIG, if you put that out, this has been outperforming the Dow Jones Industrial Average for a while now, up 10% in the last year versus 3%. They tend to own stocks of companies that are increasing their dividend, not the highest yield. Don't make that mistake. Increasing the dividend is the key. You get Procter & Gamble. You get all sorts of stocks that are in the middle range in that particular group. Johnson & Johnson even owns Microsoft. So you might want to look at some of these ETFs that are engaged in dividend, and that's when getting a very good volume recently.